Hey everyone, me Kevin here. Boy, oh boy, if Goldman Sachs is right, things might actually be getting a whole lot worse, not only in the stock market, but in the real estate market. This is quite scary. I read this report yesterday at 2 a.m. while I was on a walking treadmill in this hotel that I'm in Spokane, Washington, and I'll tell you, this sucks. So, Goldman Sachs wrote this article, and the title is Market Outcomes If the Hawks Are Right. So basically, they're going to give us their sort of prediction in the event that hawkish folks are correct. So this isn't their overall prediction. It's just that if the hawkish folks are correct, via either a moderate scenario of tightening or a more severe scenario of tightening. And in this report, they give us both how much they think equities like the S&P 500 will fall, but also they give us some insights into interest rates. And that's exactly where I want to start, because many of you know, obviously, we're launching a real estate business at HouseHack.com. If you're an accredited, check it out, read the PPM. And we have courses on building your wealth through real estate investing, 0 to millionaire. Check those out with the coupon link down below. And I want to start with real estate because take a listen to this. The 5-year Treasury right now has a yield of 3.6%. That means if you bought a 5-year Treasury bond and just held it to maturity, you would basically get 5.6% per year. It's sort of a lump sum at the end of it often. Now, what's interesting about this is 3.6% is already pretty substantially high compared to what we've been used to. But 3.6% in the moderate scenario, according to Goldman Sachs, is expected to go up to 4.5%, almost an entire 1% increase. Now, the 5-year and 10-year spreads tend to move together, but both of them considered the longer term, 5 to 10 years. And mortgage rates really follow these yields very, very closely. Another 1% increase in mortgage rates in the moderate scenario could lead to another 10% reduction in buyer purchasing power. We're already down 35% in buyer purchasing power. That's because somebody who gets a loan for or got a loan for $500,000 in December could now only afford the same kind of payment at $313,000. That's about a 35 to 37% decline in purchasing power. Remarkable, massive decline, right? Add to that another 10% drop in purchasing power. Folks, the real estate damage that we see to the market could be even worse than I'm expecting. I'm already expecting that come March and April of 2023, when we look back at peak prices of March of 2022, that is, we're in 23, we look back to 2022, we're going to go, oh man, home prices are down 10% in this city, 15% in this city, 20% in this city, maybe like the Zoom towns, right? San Francisco, keep in mind, already today in September is down 8% year over year. Boise is expected to be down like 20-25% by Q1 of next year. We'll see sort of the opposite effect of the Zoom towns happening. But folks, that's the moderate scenario where we could potentially see mortgage rates at 7% and now a 45% reduction in buyer purchasing power combined with year-over-year negatives leading to real fear in markets. This is scary. That's not the worst part, though, because the moderate scenario suggests that the S&P 500 could fall an additional, an additional 15% from levels where we sit right now, which means we would be rivaling and potentially hitting new lows compared to what we hit in June of this year, which we thought would be the bottom because June of this year somewhat aligned with potentially peak inflation. That's when I was on a beach in Germany doing the July inflation report going, oh my gosh, these numbers are terrible. We have over 9.1% inflation. Absolutely ridiculous. But what's more ridiculous is the fact that when you take out the big categories, all of the small categories of that are measured by inflation are rising. We have very broad-based inflation, and that's scary. But it's also scary because it means the moderately hawkish scenario, as Goldman Sachs has provided us with, might not be enough to actually cool inflation down. In fact, they suggest we could have to go to a substantially more hawkish stance, which would have some severe impacts to both housing and the stock market. And they believe that the declines that they mention here, while they are large, are not unprecedented, that these have happened before. And so this severe version sees the 5-year Treasury yield rising to 5.4%. That is nearly 2% higher than where we sit now. That means buyer purchasing power in real estate would go from negative 35% to negative 55%. And by all accounts, at least according to companies like Lowe's who study this and other real estate companies, the excess buyer demand that we had for real estate was somewhere around 25 to 27% at the end of last year, right? You always hear like, oh, there's a lack of inventory, there's so many more buyers. So that excess buyer level was deemed to be about 25%. For simple math, let's just say 25%. Well, if buyer purchasing power is now down 35%, then if we subtract those two, we would see about a 10% decline in prices to get to an equilibrium, right? If we get to their moderate scenario, rates go up another 1%. Now we have another 10% decline. Well, now instead of a 10% decline in real estate, we're at 20%. We go to the severe example, we could see a 30% decline in real estate pricing if the 5-year Treasury does move to approximately 5.4%, as Goldman Sachs believes is possible. But now they also give us a suggestion of what could happen with the stock market in the severe scenario. And when you look at these scenarios, both of them just straight up suck. They both suck. Because they suggest it's possible that the S&P 500 could fall below 2,900 with 5-year yields around 5.4%. That would represent an additional 27%. That would be like having a correction on top of a correction. That's very, very bad and very, very dirty. Now, this is Goldman Sachs suggesting that there's a debate around this, that whether or not can we resolve the inflation problem without a recession. And I've frequently been the believer of, eventually prices are not going to be rising anymore, right? We're going to see commodity prices come down, which we have seen already, whether it's copper or it's iron, both industrial metals, which we see a lot of responsibility for that probably because of China, along with oil, corn and wheat prices coming down, right? A lot of commodities are coming down, so we're seeing disinflation in commodities. Shipping costs have come down substantially, although they're still higher than where they were. Remember, higher than where they were does not mean inflation. It just means prices went up, they inflated, and then it's over, right? But what we really want to see is that we just don't have prices continuing to rise. And at the moment, on a month-over-month basis, we're still seeing prices rise. And so that's weird because it just goes against the thesis that we should actually start seeing some negative month-over-month readings in inflation, where it's like, oh, things actually got a little bit cheaper this month than they were last month. Now, it's possible that we're just getting impatient, right? And it takes a long time for the Federal Reserve's actions to actually take hold in the market. Sometimes 6 to 18 months are the general expectations. Old school thought is 18 months before monetary policy actually affects inflation. So that would put us at starting tightening in March of 2022. It would take until Q3 of 2023 to actually see the tightening. But by then, if we keep raising rates the way we are now, we could be in the depths of a real and serious recession or even depression, which is typically defined as 4 or more quarters of negative GDP growth, right? Which very, very possible. So that's the old school thought. Current school thought is that, it only takes about 6 months for monetary policy to really hit the market. But that's now. That's September. So maybe in October, are we going to see some negative month-over-month declines in inflation? Hopefully. But the whole hopium that inflation will end up being transitory just ain't looking very, very good right now. And so again, I just want to read you this line here. A critical debate has emerged between those who think that the current high inflation problem can be resolved without a recession, the Goldman Sachs Research Central forecast, and those who think a sustained rise in the unemployment rate will be needed. Okay, so they're contrasting two groups here. And they say that we think both views are legitimate, but we have to understand the potential downsides, the risk that we face if the more negative scenarios take hold. So that's what this is a report on, right? It's the more negative two. So if we sort of have a bell curve, this is kind of like maybe the first standard deviation to the right and the second standard deviation to the right of like pain, right? So we're not talking about the best case scenarios here. This is the worst case scenario. Either way, I do think this does create some substantial cause for pause. That is, get out of debt. Don't. It's not time to margin if this is a potential downside that we face, right? We want to be out of debt, limit debt as much as possible, and increase our income as much as possible. especially because we could face a layoff. So we want to make sure we're increasing our skills. So that way, if we were ever laid off, maybe we have more education, certifications, licenses, whatever, to easily get a job somewhere else. We want to become irreplaceable in an organization, right? But also, we want to increase our income and lower our debt. So that way, we can actually go shopping for real estate. Everybody's always said, oh, I wish I could go buy real estate back in 2010 and 11 again. Well, I'm not saying we're going to have the kind of crash that we had then when we saw single and multifamily houses drop anywhere between 40 to 50% in value. Some condos dropped as much as 60% in value. I don't believe we're going to have a foreclosure and short sale crisis like we did then, but I do think there's a substantial potential that when buyer purchasing power plummets like this, inventory stagnates on the market. When inventory stagnates on the market, people get fearful, especially as they see prices dropping. And when people combine fear with seeing prices fall, then they start doing what's known as shooting ahead of the running deer. That is, imagine the running deer is running down a chart down. If you price your property up here, you kind of have to look on screen for this one. If you price your property up here, and prices are actually right here, then you're not going to sell, right? And then what oftentimes happens is the market falls to like over here, and then you drop your price from here to here, then it's like, wait a minute, you're still behind the curve, right? You actually have to drop your price ahead of where the market is to sell. That kind of fear is something that I have not seen in sellers since I became a real estate agent back in the 2010 and 11 market, where I had to deal with that all the time. We had to shoot ahead of the running deer to actually sell listings because there was so much stagnant inventory on the market. Now, again, all of this, while it will be very, very painful, in my opinion, creates substantial opportunities. I'm not a big fan of sitting on the sidelines of all cash in this sort of market, although that does seem desirable if we get this pessimistic outlook for the stock market. However, I am extremely interested in buying real estate when this fear really starts peaking, which I believe that is going to be in 2023. A lot of people are wondering, Kevin, when are you going to buy homes? When are you going to start? Where are you going to buy them? And I don't actually have the answer for that yet. I'm keeping that flexibility open, especially for HouseHack. Remember, this is not a solicitation. If you're an accredited investor, go apply at househack.com. You can invest with me at founder shares, 1-to-1 valuation, no dilution until IPO, which is really, really remarkable and almost unheard of. But read everything at househack.com. If you're not accredited, I am hearing you in the comments. I am not forgetting you, and I'm doing my best to make sure we can get some form of non-accredited entity open or fund open, so that way we can help you participate with us as well. We're already at over 13.8 million raised, which we're extremely excited about. But anyway, in the meantime, if you want to learn and get educated, courses down below. metkevin.com/join. Use that coupon code. Be part of the daily live streams with me when the market is open, so that way we can talk about what we actually think is developing, and we can analyze real estate deals together, because that's what we're going to be doing a lot of over the next few years, especially analyzing markets. But anyway, Goldman Sachs report. Kind of scary. It's definitely FUD, fear, uncertainty, and doubt. It causes fear, uncertainty, and doubt. But that doesn't mean it's fake news, right? We don't remember. It's very important that if you are a logical person, you don't want to just call something FUD and discard it. You want to discard fake news, but you want to understand a FUD, you want to understand FUD, and you want to analyze that. Oh my gosh, yeah. There is a very real potential that the Fed continues to be hawkish and smacking the hammer here for the sake of and desire of getting inflation down, especially when we see inflation so broad-based, that we could be in a situation where we have these unprecedented yields that we haven't seen for the last 30-plus years. So this could be quite a remarkable time in our lifetimes, where I wouldn't be surprised if in 40 years, 30 years, after a mortgage, we look back and we say, oh my gosh, those were some of the most painful years following some of the most glorious years. I mean, talk about how the pendulum has swung. Very, very weird. Anyway, thanks for watching, folks. We'll see you in the next video. Goodbye, and hello from Spokane, Washington.